There's really only one thing to say about the global economy at the moment, which is that we are in a pretty deflationary environment. Our forecast for interest rates is a steady glide path back up to 4% by 2020, which is lower than the peak of the last cycle. Actually, the UK is relatively well insulated from these sorts of problems in China. The EU exports only 1% of its GDP to China, or it makes 1% of its GDP through exports to China. Germany is much more exposed than we are. The most important indicator of what's going to happen next, the US unemployment rate. And when the US unemployment rate hits the bottom, that means that we have a tight labor market in the US, which means that inflation, wage inflation, starts to rise in the US, which triggers the decision by the federal bank to raise interest rates. The EU is a very interesting picture, I think, and is actually doing better than many people expect. We're still suffering a bit from the shadow of the Greek crisis. We think that GDP in 2015 will turn out at about 2.7%. And in 2016, contrary to the consensus view, we think that the UK economy will grow by 2.8%. Retail sales figures are above 4%, have been above 4%, in fact, for nearly 2 years now, so stable at a high level, which is good news for us. And also confidence, similarly, above zero, so net positive for nearly 2 years now, a useful indicator that things seem to have stabilized. 2014 was a record year. There was more investment in real estate in 2014 than there was ever. We are a very open economy. We are very open in particular to overseas investment. And as you can see, a huge amount of money came into London in 2014 and the first quarter of 2015. The point about the current level of investment in real estate is that it is predominantly funded by equity and not debt. So whereas in 2007, the proportions of equity to debt were 1/3 to 2/3, those proportions are currently reversed. 6 points to make. Firstly, that the global economy is slowing a little, but that is keeping interest rates low, so we are definitely in a low or moderate growth and low inflation world, and we can't see that changing anytime soon. Secondly, that the fundamentals in the US and the UK are good, and the EU is starting to recover. Thirdly, that we have a strong investment picture in the UK. Fourthly, that yields are still falling and rents are still rising. Fifthly, that property still offers relatively good returns, and the emphasis is on the relatively there, definitely at the moment. And for those who are worried that we are about to repeat the 2007 mistakes, we would argue that only some of the elements of the last cycle are present today and not the ones that we think caused the problem last time round.